Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to Fundamentals, our regular analysis of the world of funds and collectives, where we look at the most popular purchases on the AJ Bell Invest Centre platform and then investigate why they might be so popular. This week, prominent on the list of passively run funds is Vanguard's FTSE 100 ETF or Exchange Traded Fund. An ETF is designed to track, mirror the performance of the underlying assets and deliver that performance minus any running costs. In this case, Vanguard FTSE 100 ETF uses physical or direct replication, so it owns the underlying securities, which in this case are the UK's biggest firms by market value. HSBC, Shell and BP are the top three positions. The ETF comes with an ongoing charge figure of just 0.09%, so it is cost effective. According to data from Morningstar, only two iShares FTSE 100 ETFs are cheaper, and only a product from DBX Trackers comes as cheaply out of a field of 24. The Vanguard product is SIPP and ISA eligible and comes with a yield of around 4% at the moment. Note any client buying this would be buying income units, so the cash will be distributed rather than rolled up and reinvested as would be the case with the accumulation units. This may influence some clients' thinking depending on their needs and investment strategy. As a final point, Vanguard FTSE 100 ETF began trading in 2012, has a 3-star Morningstar ranking and 1.8 billion sterling in assets under management, so it's big and should be pretty liquid, at least under normal market conditions. This chart here shows how the ETF has performed since inception. Okay, that's the mechanics. So the question is, why should advisors and clients be thinking about it now? Because somebody clearly is. It is possible some have been tempted into action by the summer's volatility, which has left the FTSE 100 trading some 14% below its year and all-time high. A 4% yield may also tempt income hunters as well as contrarians, especially as the globe's central banks seem to be in less and less of a hurry to raise interest rates. Subdued returns on cash and low bond yields may also leave some clients looking for income. Some may feel the additional 200 basis points of yield on the FTSE 100 is worth the risk relative to, say, 10-year gilts, especially as that yield gap is high by historic standards, as this chart shows, going all the way back to 1986. A score below the x-axis means bonds have a higher yield than the FTSE 100, and a score above it that equities offer the superior yield. Now the next graphic then maps the same yield gap relative to the FTSE 100, so it's possible to argue, based on the basis of historic data, that the index looks decent value, even if the catch is clearly the past is no guarantee for the future. This graphic only looks at the index post 2008, when equity yields have tended to be higher than those of the 10-year gilt yield. Now the current gap of 2.1% has only been seen twice before, and on each occasion it's proved a buying opportunity for the index. We now need to see if it is third time lucky, again in the knowledge the past does not offer any certainty for the future. A final thought, any client who buys an ETF or tracker fund needs to know what they're tracking. In the case of the FTSE 100, just 10 firms make up around half of the index by market capitalisation. In addition to that, around half of the pre-tax profits and half of the dividends forecast by the analyst consensus for 2015 come from just 4 sectors: banks, insurance, miners and oils. Now all are quite volatile and may not sit easily with every client's risk appetite. Thank you for watching, and I look forward to seeing you next time.